So one theme which has done extremely well post-COVID is public sector undertakings, and they have delivered stellar returns. So we have done an analysis using stock price movement. So CPSC index and public sector banks index and compared it with the Nifty 50. So data for CPSC index is available from March 2014. This is from Google Finance, and we have calculated rolling returns for 1, 2, 3, 5, 7, and 10 years. So for year one, the minimum return has been around 48, negative 48%, and the median at 11, and max at mean at the 15%. So we can observe negative returns are absent only after 10 years. So even at the 7 year stage, there are negative returns. So now let's compare this with Nifty 50. In this case, negative returns are absent after 7 years. So even at 5 years, whatever negative returns are there, that is at 0.75% of the instances only. And the median, mean, and the minimum return, they usually fall within the gap of 3.5%. On day change basis, both are somewhat at a similar level. That is around 46% CPSC and Nifty 50, right? But there is a drastic reduction in number of negative instances as we increase the time horizon. This is the case for Nifty 50. So after year 7, there are no negative instances only. And at year 5 and year 3 as well, and even after year 2, it is less than 10% of the instances. At 5 year level, the negative instances for CPSE are at 45% compared to Nifty at 0.75%. And the median returns for Nifty 50 across time horizons is around 12%. So if you look at it from 11.3% to 12.5%. So and for CPSE index, this is varying from 4.5 or 3%, even 0.3%, anywhere between 0.4% to 11%. Now let's go to the PSB index. Here the data is available from 2011. So I have taken the similar time horizon for Nifty 50 as well. And we have calculated the rolling returns in the similar way. And PSB index has done worse compared to CPSC index as well, not just Nifty 50. So there is a negative 40% of chance that there is a negative return even after 10 years. So this is from 2011 to the present date. Across the time horizon, if you look at the median returns, so they are anywhere between negative 2% to 4%. So, and percentage of instances of negative instances are anywhere between 40 to 60%. So for similar time period, chance of getting a negative return in Nifty 50 after 5 years is like around 0.49%. So median returns are around 12%, making Nifty 50 a better bet compared to CPSC and PSP index. So just to show how volatile PSU stocks are, so I have taken few stock examples of the sample is like a 14 stocks is what I have taken, and then I'm comparing with the Nifty 50 index. So the first 10 are banks and the rest are non-financials. And see, column C indicates the share price as on 1st of January 2010. So the next is I have taken the major events. So this sheet essentially shows all the data just before a reform. Say, for example, AQR was announced on 1st January 2015. So I've taken share price on 1st January 2015. So the reform actually takes place for 1 year, and what happened in the 1 year is what we have to look at. So, and for we have considered demonetization, GST, IL&FS, COVID, and the Ukraine war as some major events. So, and again, the next page shows the absolute returns actually. So you have to read it this way. So Bank of Baroda. So the price of the stock was 103.14 on January 1, 2010. So on the day when AQR was announced, that is on 1st January 2015, its value is at 216.61%, 61 rupees. So that means a total gain of 110%, right? So whatever you are seeing in this place are the absolute returns apart from these last three columns. So from January 1, 2015 to January 16, So due to the PSP, due to the AQR review and everything, all the PSP stand. So SBI corrected by 27%, PNB corrected by around 47%, right? And Bank of India corrected by around 61%. So up to demonetization time, few of the stocks actually recovered. If you look at the Canara Bank and even India Bank, it recovered by 97%. So it may look as a great number, but whatever was 100 declined from 100 to 53. And whatever was at 53, it has grown to some probably around 100 rupees. Right? From November 1 to December 31, 2016. So the stocks were in a correction mode again. So this was during the demonetization, right? So from January 1, 2017, right after the demonetization was completed, to July 1, 2017. So GST was announced here. So, and stocks did relatively well. Like there was a lot of recovery because of all this stuff. Like the correction were anywhere between 25% to 60%. So again, so whatever recovery you are seeing, it did not make up much. So from that point to IL&FS crisis, so PSU stocks were in a big correction mode again because there was a huge exposure to that NBFC. So from ILFS to COVID, most of the public sector stocks lost by over 60%. There are few which have done around 30%, but there are again a few which have done in 80% as well. So there is hardly anything like 25 and 26 are the least corrected ones. So compared to the index, which was at 20%. This is as of 31 March 2020, right? So by October 2020, the market has pretty much recovered and was at pre-COVID levels. But that wasn't the case for PSBs and CPSs. Let's look at the example of SBI, right? So it was at 196 rupees, uh, 196 rupees compared to 229 rupees it was trading on January 1, 2010, right? So on 31st October 2020, assuming that the COVID recovery has happened, so it was still at 196 compared to 229, which it was trading on 1st January 2010. So next crisis is Ukraine war. So, but the PSPs and CPSCs gave great returns, and that continued till June 2024. These are the returns which people started associating PSUs with, where in 3 to 3.5 years' time, their price jumped by 2 to 5x. Let's take the example of Bank of India. So it faced a huge setback after AQR. Right? Bank of India during the AQR it corrected by around 62%. And its price dropped by almost 70% in 6 years. Right? This is from if you look at its price, so Bank of India's price in 1st January 2010 was 392 rupees. So after AQR, it is at 117 rupees. Right? And from there to COVID, it lost another 70%. So 117 rupees to COVID, it is at 32 rupees. That is, what was at 100 in 2010 became 15 in 2020. And from there, it rallied by 200%. That is, this 15 rupees has become a 45 rupees. So a person who held this stock from January 1, 2010 to June 1, 2024 had a negative absolute return of 55%. These are just rough back of the hand calculations. Let's see. So 392.95 to June 1, 2024. So to 132. So that means like you have lost more than close to 60%. So from June 1, 2024 to December 31, 2024, again, most of the stocks corrected by over 20%, right? So this was a lot of volatility was there. One was due to the presidential elections in US. So from January 1, 2025 to 28 February 2024, so most of them corrected by 10%, right? Again, the broad market correction was more due to the, one was due to the earnings slowdown, and second was due to the tariffs discussion which was happening. So, but I don't think there is a much of a correlation between tariffs and the loans given by a bank. So Sometimes the excesses get corrected even when the events are not when there is no correlation between the events. So across, like there are 12 time periods here. So across the 12 time periods, if you look at Nifty 50, right, it has delivered only four absolute negative returns. So, and of which three are between 3.5% to 6.5%. So one was during the AQR, and the second was during the demonetization period, and third was during the again, this is more about today's price, right? And this is today's price from 31 from December 31st, 2024. And finally, the around 20% correction was during the COVID, so which was totally an externality. But that can't be said about any other PSU. Now let's look at the CAGRs from January 1, 2010. Nifty 50 has delivered around 10%, that is 9.97%. And it has done better than all the stocks which are there in the sample, all the 14. So all these 14 do not constitute the entire index, but I have just taken a sample here. So there are only two PSU stocks. One is like SBI and the other is Indian Bank. So which have delivered over 7%. That means they have done slightly better than the inflation, which is at 6. And the six stocks have delivered negative returns. Now let's split the CAGR and see what has happened before the COVID. So till COVID low, and what has happened from COVID low to today. Right, from January 1, 2010 to 31 March 2020. So of the sample taken, not a single stock has delivered a positive annualized return. Right. So from COVID low to the present, every stock in the sample has outperformed the Nifty 50. So the issue here, this is the main issue, right? The investors are viewing the PSUs with this recency bias. So, and they think that the CAGRs of 20 to 65% are very common in the PSU stocks. So the returns for 2.5 years from January 1, 2022 to June 1, 2024 is basically skewing this data. So making this subpar returns over the last 15 years, it is making into something extraordinary. So the main reason to highlight this data is to make an investor understand what he or she is dealing with and to caution them, right? So, and again, finally, it is always better for an investor to go with an index fund or an active fund manager in case he or she is not adequately equipped to do the research. So if you are somebody who knows how to do all the stuff and if you are well equipped and if you are willing to spend time, definitely you can go ahead and buy the stocks. Otherwise, it's best you take a chance with an active fund manager or just go and buy an index fund. And always invest basis the your asset allocation and your goals and the time horizons. So this video is for educational purpose only, and it is neither a recommendation to buy or sell asset class or stocks in the discussion. Thank you.